Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and today I'm excited to have Ashwin Raguraman, who's the founding partner at Bharat Innovation Fund, which is an early-stage venture capital fund investing in deep tech startups from India, addressing global markets. Bharat Innovation Fund has led investments in Entropik Technologies, Deeptech Technologies, Zumutor Biologics, and Ashwin was earlier the founder of India Innovation Fund as an alumni of Symbiosis International University. Welcome to the show, Ashwin.
Hi, Rohit. Good to be here.
Awesome. So how did you get into the world of startups and venture capital?
So it goes back, Rohit, to my last fund.
Right.
I've had a fairly non-linear path into venture capital. I've done very different things in my past life.
Right.
But back in around 2008, I spearheaded something called the Innovation Initiative from NASSCOM, which is the industry body for IT in India. And one of the things that we realized as, our mandate was really to promote innovation in the industry. And we realized that a lot of the innovation was not going to originate necessarily in our large IT services companies or even in the mid-sized companies, but is going to originate from startups, which were extremely dynamic. And we caught that trend a little bit early. Startups itself were not the flavor of the day back in 2008-9,
Right.
And definitely not deep tech. But we thought that we should be promoting some of this in India, and we felt that startups is where the intervention should be, where we can try and support them. And therefore, we decided that, let's put out something which goes beyond just mentoring sessions, which we were already running, weekend mentoring sessions and support for startup market access programs. And we said, let's bring all this together and have as a central focus a fund which will actually support startups that we want to encourage and provide a tailwind to. And so my role was really to set this fund up, get it running, get a few people to come and run it, and then move on to other things. But very interestingly, the set of people that I created as a board for this fund, we created it as an independent structure outside of NASSCOM so that it could be SEBI registered as a professional AIF. And the minute I set up a board, they said that, why don't you, since you've been involved in really setting up the whole thing, why don't you come and be a part of the investment team? And that's how I got into the investment side of things. So it's been a decade or so, and it's been extremely fulfilling and exciting as well.
Interesting. And how do you think about portfolio construction, and what is the investment thesis when you're looking at deep tech companies here in India?
So to be honest, we started this almost as with my first fund, the India Innovation Fund, as a mission, right? Can we support deep tech startups out of India? Because we felt the next wave of technology out of India needs to come out of products and deep tech and not just IT services or services in other sectors like healthcare. And our early efforts were therefore slightly mission focused, but we said we need to run this professionally and have a returns focus as well. And we tried to marry both a mission and a returns focus. And when we set it up, we had no idea whether we're going to get strong deal flow, the sort of startups that we're going to see. And fortunately, we tasted some success. And what we realized out of our early experience was that while deep tech started off as a mission for us, strategically, it was something that could actually form a moat for startups. And therefore, a startup which is at the cutting edge of technology, as long as it gets its execution right and it gets over the early, product market fit hump, suddenly becomes very attractive to later stage investors and is able to even address markets, that others can't. And so it became a fairly strong strategic play as well. The fact that we want to, focus on deep tech as a filter in the startups that we are trying to support. And the other part that we discovered is there aren't too many deep tech focused startups in India. In fact, there were none at that point in time.
Right.
And even now there are only a handful. And we realized therefore we were playing in a white space. And there are certain intricacies in diligencing startups in the deep tech space that we had acquired some knowledge about as well, which comes handy now.
Interesting. And what do you think about market size when you analyze an investment? Is it important to look at TAM when you are trying to analyze an investment?
So I'll answer that question in two parts, Rohit. I think it's a very pertinent question, and it is, of course, something that we need to look at, market size. However, when we are talking about cutting edge technology, startups which are at the forefront of innovation, very often they're addressing a market that doesn't even exist at the time of their creation. And there is a certain amount of market development that requires to take place. I've also realized, having studied the likes of a Flipkart or a Paytm and so on, is that many of them started off addressing a market which, if you really look at it, wasn't a scale market. They pivoted multiple times. Right. And broaden their offerings to really hit a scale market, become unicorns, right? And so the learning is twofold. One is you need to look at a little bit about not just what is today's addressable market, but what could be tomorrow's market size. And at the same time, you also need to realize that if the ingredients are right, which is very strong technology, which is a good set of founders who are capable of executing, but have the flexibility to pivot or to look at adjacencies, then, the market part of it will take care of itself. And you can't always go by a number that is there today as an addressable market, and you'll have to look a little bit into the future as well.
Right. And, what is the right level of diversification across a portfolio to be diversified at, seed and pre-seed level? And how do you look at, reserve allocation these days?
So let me answer the second part first, Rohit, which is, I think it's very important. One of my biggest learnings from my first fund was that your returns are always better when you're able to participate in multiple follow-ons, especially if you are an early stage investor. As you go into your future rounds, as you move from pre-series A or series A towards series C and series D rounds, the rounds become quicker, and at the same time they become bigger, and your ability to participate strongly across those rounds also leads to better IRRs, which is one of the reasons why we exist as funds, which is deliver returns to our investors. Right. And so when we look at dry powder, which is reserves, we definitely like to hold back at least 50% for follow-on rounds in our startups. And our strategy will vary from startup to startup as in terms of, and as we see how they evolve, as to how many future rounds or follow-on rounds that we will participate in. But I do believe with the successful ones, the longer you're able to hold your position, you're able to get stronger, or let's say better returns. On the first part, in terms of portfolio diversification, I think it tends to happen fairly naturally with the filter that we've applied, which is that we are saying we are going to focus on startups that have a deep tech component or an emerging technology component. And having applied that one filter, we said that let's not apply any further sectoral type of filters across this. We do look at startups that we think have technology that is either globally competitive today or has the potential to become globally competitive very soon. And when we apply these filters, and we are fairly sector agnostic otherwise, by default, there is a certain level of portfolio diversification that happens from a sectoral type of allocation. And that reflects in the 6 startups that we've invested to date in the last year and a half or so out of the Bharat Innovation Fund. We have one company in media tech, another in fintech, something else which is at the intersection of IoT and oil and gas. There's a fourth which is in biotech. So you see where I'm going with this, right? We're
Right.
fairly diverse without really having to make an effort to diversify our portfolio.
And are you also stage agnostic?
No, we like to limit ourselves. I think there's a very different knowledge graph in investing early stage, and the way we define it is pre-series A to series B. Our sweet spot is series A, but we do participate in some series B rounds as well. I think that is very different, let's say, investing early stage as compared to investing in later rounds, and therefore we have restricted ourselves to these three stages.
Interesting. And Ashwin, these are testing times for startups and founders because of the COVID-19 situation, and it could be there could be an impending crash. But what are the few things which you could advise founders to prepare for the next 3 to 6 months?
Wow, I think we've been as a team at the fund been looking at what a whole lot of other funds are saying, what other LPs are saying, and there's so much information out there and on what should be done and what shouldn't be done and so on. I think fundamentally everybody's got the messaging right? Which is at the end of the day, how do you preserve cash and how do you extend your runway as far as possible? Because there is a certain element of uncertainty and we still don't have a direction as to how things are going to pan out. The second part of it, which I think is a little bit more specific advice that is coming out from our side, is also to have the flexibility to see what adjacent areas you can service, so that there aren't teams that are sitting idle in this situation. I mean, to give you an example, there's a company in my portfolio that does work using drones, automate or to help with safety during large plant shutdowns, and there's a focus on the oil and gas sector. I mean, that's one of their offerings. And they've realized that there is a need for drones in the surveillance space in a larger way, and they've been getting inquiries from state governments to help with that during COVID. And while this is not in normal times, this is not an area we would look at because it's fairly crowded and we would not want the startup to venture into that area. We realized that, their drone pilots, for example, are sitting idle, right? And therefore, why not use them for something which is important from a, both a national perspective and at the same time, be able to keep, the lights on and keep things running. And so a little bit of flexibility in trying to adjust to the situation is the second piece of advice that we are giving them. And the third one, I mean, it sort of relates to the first one, which is you don't know how or when you're going to be able to collect money from customers. Keep your engagements going as long as you can. There will be a time when your customers who are perhaps a little bit conservative out of making payments now will sort of open their purse strings. And therefore, this is perhaps the time to build strong relationships with your customers by, providing them as much support as you can.
Right. And also you've been part of the downturn in 2008 and 9. How does this downturn will compare to, one which happened in 2009? Do you think it's going to be really bad or it's going to get better after 2020 or 2021?
I think it's a very different one to the extent that this is triggered by something which is very different, right? Which is a health type of pandemic,
right,
which wasn't the case last time. So the variables are very different, which is really whether we are going to be able to, how quickly can you eliminate the virus, quote unquote, eliminate, as in to the extent that it tapers off and there are fewer and fewer infections happening. The second is how quickly can you get something which is therapeutic out there in the form of some sort of medical therapy. And then third is when do you get a vaccine out there. So the outcomes here from an economic standpoint are very largely dependent on some healthcare related outcomes, right?
Yeah.
And to that, there is a lot of difference. So if you really honestly ask me, what am I looking at as my first port of call or a leading indicator of how things could be, I'm looking at how quickly the cases are going up, let's say in India or other parts of the world of COVID infection, right? I'm looking at how many people are dying because of COVID. I'm looking at how the geographical spread is. And so those are the factors that I'm looking at, leading indicators, rather than purely economic factors, which I would have looked at in 2008-9. And I think a lot of what happens economically will be based on how quickly we can address the health, part of the problem and the challenges related to the health problem. And I don't think there is anybody today, including experts in the healthcare field, who can very clearly tell us that this is the direction in which things are going. And, they would have to be a little bit of a Nostradamus to be able to do that at this point.
Right. No, absolutely. No, I want to go back into looking into your investment thesis, and what are the signs which you look at when you're looking at investing into a founder, and and are there any metrics which founders should hone on so that they could look at the next round of funding?
Yeah, I think being a founder is extremely challenging, and it's a very fine balancing act that you need to play, right?
Right.
And I'll tell you why it's a balancing act. You're juggling very, very different problems. Forget about from day to day. Within a day and every hour, you're dealing with a very different type of a problem, right? At 1 hour, it could be an HR problem. The second hour, it could be a cash flow problem.
Correct.
The third hour, you could be, talking to an employee about who's going through some stress. So it changes from time to time. And I think the balancing problem that a founder really needs to be able to, or the level of balance that an entrepreneur needs to be able to achieve is to be able to listen and get inputs from multiple places, because you can't know everything yourself. But at the end of it all, having got inputs on, let's say, a topic from multiple sources, be it your investor or other entrepreneurs or mentors, is to be able to understand what is really important and to understand what to discard as well and what to take and follow, right? And so you got to have your own mind, while at the same time being able to listen to other people and to be able to follow what they're saying. And I think that's one piece. The second piece, which I really think I evaluate to a large extent when I'm evaluating either an entrepreneur or a founding team, is to figure out how much they understand about the space that they're already in. If I, as an investor who's not in a particular business, I might have evaluated 5 companies which are in a certain space. If I have found that my knowledge is more than an entrepreneur who's pitching to me and he or she is trying to build a business in that space and doesn't know it as well as I do, then there is a problem there, right?
Right, correct.
And so when at the end of a conversation, I just come out of that meeting and I say, have I learned something about the space which is extremely new? How much have I learned? And how much do I get comfort that an entrepreneur has really figured out the nitty-gritties of the space, all the dynamics that go into, what that space is about, and then therefore has understood the problems well and has come out with a solution for that space. I would say this is perhaps the biggest thing that I evaluate in a founder.
Right. And are there any metrics which you look at, or any metrics which you disregard when you're looking at investing into a startup?
Into a startup, yes, not necessarily a founding team.
Okay.
We do look at, like you mentioned, we do look at market sizes and where they could head. We do look at, even though we're an early stage fund, we want to see product market fit. And so we don't look at revenue as a number, but we do look at, some level of traction, and therefore the capability and the validation of a paying customer. The third part is we do look at unit economics very seriously, right? Not necessarily what today's unit economics are, but what a steady state unit economics would look like, because I think that is fundamental to success of it, the success of any startup. And so these are possibly 2 or 3 things that we look at. One of the other ones that we are able to look at the early stage is also what sales cycles are looking at. Given that many of our startups are in the B2B space, and therefore the ability and the time that it takes for an entrepreneur to be able to get his solution into his clients is something that gives us some indicator as to what his ability to sell, his or her ability to sell is.
Got it. And Ashwin, for a CEO, it is really important to build a great team. So what do you think, in your view, are some of the best CEOs looking to recruit the best talent in their team? What should they do to create a second level of leadership team below them? And is there anyone in your portfolio who's done a great job with it?
Yeah, I think this is a very important point. I mean, you hit the nail on the head. I mean, at the end of the day, we invest in great founders.
Right.
And I think one skill that a great founder has is the ability to inspire and bring in talented people into a fairly low resource situation, right? I mean, a startup cannot pay very often, even a funded startup can't pay and don't pay as much as people with great expertise may get from a large company. And therefore that ability to inspire people and to demonstrate or to show somebody else your vision is something a great founder will always have. I think many of the ones, there are at least 2 or 3 founders that have been either earlier part of my earlier portfolio or this current portfolio who've been able to demonstrate the ability to build the next level well. And I think the way they have done it is that rather than thinking about hiring as a typical recruitment process, they have really spent time with potential candidates, sometimes many months before they've actually gone in and brought the next level of talent into their company. So they've thought ahead and said, perhaps in March, that listen, I need somebody by September. Let me start engaging with 2 or 3 of these candidates, have conversations, use their networks well to be able to identify potential hires for senior roles. And then there's a conversation or multiple conversations that happen so that there's a level of comfort that is established. And this is very important for startup teams or to build startup teams is what I feel. The other point on this, the whole hiring of the team part is, very often we've got into companies, before they have the next level of teams. And therefore we've seen the journey from, let's say, a founder-driven startup to a startup that has the next level of teams. Some of them are actually building out their next level, the ones that are in my portfolio. And I can tell you this, the early stage of a startup before they perhaps raise a Series A round, very often the founder, if it's just one founder or even if it's 2 of them, a significant portion of their time is either going into developing product or into acquiring customers, right? So typically there'll be this one product guy in the founding team and the other guy will be the customer facing guy and will spend a significant portion of his time acquiring customers. The minute you raise a Series A or maybe even a Series B round, more than 50 to 60% of your time is actually spent on getting the right team together. And I've heard many founders say that, hey, all I'm doing morning to evening is trying to either engage my existing team or in bringing in new people into the company. And I think that's the only way to go about it.
Interesting. And what has happened in the last couple of years, especially in the Indian ecosystem, is we got a large number of early stage funds who've come in, and an equal number of entrepreneurs are trying to build some exciting products. So do you think there's been an oversupply of capital, and has that changed the founder and VC dynamic since you've been investing the last 10 years?
Wow, that's another good question. If you ask me honestly, there isn't an oversupply of capital.
Okay.
There is still a shortage of capital in India, especially domestic capital. And in some sectors like biotech, if you try and raise large Series B or C rounds, a lot of our companies actually need to raise that from the Western world. So we do need more capital, and there isn't as much. There is a lot of, I mean, as you correctly pointed out, the number of entrepreneurs have significantly increased.
Correct.
And therefore, I've seen two things happen, which is because the base of the pyramid, as far as the pipeline is concerned, has more or less, or base of the funnel has increased in size. You're having a lot more quality entrepreneurs who are finally, getting funded, and then there's a greater possibility of successful entrepreneurs or unicorns or whatever metric you use to define a successful startup. At the same time, what I've observed is there's a lot more noise in the system as well, right? Entrepreneurs have become smarter and entrepreneurs have become more mature, but what has also happened is that there are entrepreneurs who are not that great, but who've realized or who learned to pitch extremely well because there's a lot of knowledge floating around, right? And it has become harder to separate the men from the boys, to be honest, for investors like us. But having said that, I think that's just a smaller problem. I think the larger problem is that there are so many good entrepreneurs who could make it had they the risk capital that they needed at the right time. And being able to sustain yourself through every entrepreneur goes through different points of low in their journey, especially in their early journey. And there are many who have succeeded only because they somehow managed to survive at the low times. And I would imagine that percentage would go up significantly if we had a little bit more risk capital for, the valley of death. And some of those startups which otherwise, die, had they survived and crossed that chasm, would actually have ended up or will end up becoming extremely successful.
Correct. And, this is for founders who looking to drive, value from the board. What advice would you give to founders on, how to make their boards as efficient as possible, and what advice to take on and what to disregard when they're looking at taking advice on the board?
So Rohit, it's a little hard to answer this question from in a very broad sense, simply because every investor who comes onto a board behaves very differently, right? And different funds have different levels of, let's say, touch. Some are high touch with their entrepreneurs. Some prefer to invest and then, just sit back a little bit and give a lot more space to the entrepreneur. So it is a function of, I think, when the entrepreneur decides which investor to go with, assuming they have a choice, or which investor to approach first. I think it's important for them to speak with other entrepreneurs who engaged with some of the investors they're looking to tap into, to try and find out how those investors behave when they're on their boards, just to see whether that's the sort of style of investor that you want, right? And so there's no single answer. We ourselves, or I myself, truly believe that as a board member, our role should be restricted to the fact that we are nothing more than a sounding board to the entrepreneur. And I think that's the first role that we should play, which is help the entrepreneur think through his problems, make sure that he's thinking about all aspects, taking all risks into account, not missing out on opportunities, and really truly acting as a sounding board, because life can become lonely for an entrepreneur, especially in their hectic sort of, lifestyle. We do help, and most funds, I think, which are of reasonable quality, do help in other aspects like, market access to market and access to follow-on rounds of funding and other investors. But if you go beyond that, I would just say that the style I like and prefer is to be a sounding board to the entrepreneurs. And therefore, my advice, to answer your question a little bit more directly, my advice to entrepreneurs would be to understand the person who's on your board well, establish a strong relationship with that board member by adapting to the sort of style that you see that person having. But even before you get into all that, if you do have the ability to choose either your board member or therefore your investor, then choose somebody who you think will fit your entrepreneurial style.
Right, because it could be a 10-year journey, a relationship with the VC and founder.
Yeah, and it's a very, very, I think some entrepreneurs may actually end up spending more time with their, board member or investors than they do with their spouses. So, maybe you need to give this a lot more thought than, you do otherwise.
Interesting. And I quickly want to do the top three. What's your favorite business book?
So when you say business book, can you
it could be a non-fiction business book.
You're talking about an actual book. Okay.
Correct. Yeah.
Something along the lines of a playbook. So I think just out of pure non-conformance and true entrepreneurial spirit, there's a book by Richard Branson called Losing My Virginity, which stands out in my head as a business book, if you can call it that I really enjoyed reading.
Correct. I'll put that in the show notes. And, if you could go back in time when you started your first fund, what is the one thing you would have focused on or done anything differently?
That's a good question. Would I have done anything differently? I think there were so many variables and unknowns that we were trying to address that I actually don't think we would have done too much, very differently. We did have a successful outcome with that fund. We had a full exit of our portfolio to a secondary fund. We did exit some company individually as well. I think the way, or I would have, tried, what I would have preferred to have done with that fund is to be able to actually think seriously about a follow-on fund to that. Which we didn't do. And perhaps, so not while I was setting up the fund, but towards the later part of the fund, I would have seriously focused on trying to figure out how we could follow on with another fund to that.
Got it. And do you have any favorite online tools, example, Gmail, Slack, Zoom?
Yeah, I think there's one reason why, forget about the recent bad press. But if you think about it, otherwise, there's one reason why the Zoom IPO really, really did well, right? And it's because it's got a fantastic product. We're talking on Zoom right now.
Correct.
And I was so glad when I saw a Zoom link rather than, some of the other links that are shared for some of these conversations. So I think they've got a fantastic product. And then, look at it this way. The last couple of weeks should have been extremely challenging times for Zoom because half the world seemed to move from physical meetings to online meetings. And I'm sure a lot of that load would have come on Zoom. And they seem to have managed it well. The quality of my calls are still as good. We're having a great conversation here. And so they've managed that transition. At the same time, I'm just thinking about the tools that I used prior to Zoom for exactly the same purpose. And Zoom is a, clear head and shoulders above some of those in terms of what it delivers in terms of quality.
No, absolutely. Zoom is also one of my favorite products. I've recorded more than 100 episodes on Zoom. So that's one of the products I love. And what is the best way people can reach out to you and know more about Bharat Innovation Fund?
I think, my email is out. I'm on LinkedIn, and normally when people reach out to me on LinkedIn, I share my email so that people can write in with further details. So it is typically the easiest way to get to me. Otherwise, I'm at ashwin@bharat.fund. They can email me directly and talk about their startups. The only caveat or the only suggestion I have to people who reach out is to do their homework a little bit on areas that we invest in and reach out basis that and basis whether they think, we would invest or we can help in any other manner. And that goes a long way when we see that an entrepreneur has done a little bit of homework and taken the trouble to read a little bit about what we're investing in or what we've invested in terms of our overall initial impression of the person who's reaching out to us as well.
All right, we'll put the email and LinkedIn IDs on the show notes. Thank you so much for taking our time and speaking to us. I really appreciate speaking to you.
No, pleasure talking to you, Rohit. Appreciate all the questions you asked and hope you have many more such podcasts.
Thank you.
Thanks for listening to the Life Self-Mastery podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.